freedom isn't the result of wealth. It's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey. I'm here with Adam Penn. Adam, what's up today?
Just got back from a flight. I actually timed I had to pick a flight that was going to get me back here in time to be able to record this interview.
Very nice. Very nice. Where were you flying in from?
Salt Lake City, but via Tennessee, because I was in Memphis dealing with rental properties out there. We have we've done a fund out there. We've bought some real estate. I think we've talked about before, the market's turned a little bit out there and we've had contractor issues. Still cash flowing, right? So, I always think about it in the back of my head, oh God, that deal, it's not doing great. But I'm like, we're not negative cash flow and we haven't lost any buildings and we have a good amount of equity. So in the terms of all the things that have happened in the last 3 years, we didn't do horrible.
And not to turn this into an episode about Memphis and not to name drop, this is completely true. I was on a call yesterday with Ken McElroy and Scott Saunders and a couple other people, and they were talking about Memphis specifically. And I had missed the news that Google has announced they're building this like $10 billion data center over just across the river in West Memphis, Arkansas. And so it's going to inject a whole lot of stuff into the overall Memphis economy. So
the bridge isn't broken anymore.
What's that?
And the bridge isn't broken anymore.
I know you can actually drive across the bridge. Memphis, as a total aside, Memphis is still a decent place. It's a different market, but it's growing.
We should put that thing you just said in our next investor update to all the investors for the Memphis funds.
I'll make sure to do that. Yeah. Well, anyway, that's not what we're here to talk about today. Today, we have a guest.
We do.
That I'm very excited about.
Yeah, we've got Bob Fraser today from Aspen Funds. We've talked about Aspen a lot because we've raised some money for them and we've got our credit fund with them. We're doing an oil deal with them. We really like the way they analyze deals. So Bob's got a ton of experience. He's started companies, had companies blow up. He's just got a massive knowledge and he keeps pushing forward. He's an entrepreneur through and through. Great way of looking at things. And I think he says it, huh?
I was just going to say former software engineer from Berkeley.
Former software engineer. Me and him are both pilots. We both have small planes, and it's fun. He's a great guy. I think everyone will enjoy the interview.
Yeah. Well, let's dive right into it. All right, Bob, welcome to the show. We're super excited to have you here.
Yeah, so fun to be here with you guys.
I can kick it off if you want, Dustin.
Go ahead, Adam, yeah.
From the get-go, why don't you tell some of our listeners, if they're not familiar with who you are, kind of your journey, just the elevator pitch. What brought you to running Aspen Funds today?
Yeah, well, it's a little bit about Aspen. We're a private equity firm, so we manage, build and construct private equity investments for investors. And we're in a number of verticals. We're about four main verticals right now: oil and gas, real estate, development, and credit. And so we put together really good funds. We generally look ahead. We try to be not your average investor, like everybody. You've got a hammer and everything looks like a nail. We run it. We're data driven. We're macro driven. So we're looking at the big macro trends to figure out where should money be placed. Then we're figuring out the best way, the smartest way to place capital in these things. So we kind of think like a hedge fund, but act like private equity. Mm-hmm. Yeah. So that's what we're doing now.
It's been interesting to follow you because I met you probably about 4 years ago, and I'm like, oh, that guy's on stage. He's kind of cool. And then now we've actually raised some money for you. We've raised a fair amount of money for you, and been out to your place in Breckenridge, and it's been really great getting to know you. And one thing that I think might resonate with our audience a lot, and we have a lot of tech listeners, is you started on the more tech entrepreneurial side, right? You want to dive into that a little bit?
Yeah. So I'm a magna cum laude Berkeley computer science grad. Okay. So grew up in Silicon Valley. My first job out of school was working for Atari Inc. and writing code for games. quickly went into the Atari corporate research division, which most people don't even know they existed. Worked for a very famous computer scientist named Alan Kay, and was part of their R&D division. And so it was a lot of fun. Did coding for about 15 years. Loved it. I just loved computer programming. You guys are tech weenies, right? You know how fun it is to write code. And I did that, and then always had an entrepreneurial itch. So in 1995, got my sister-in-law, convinced her to come work for me, and raised $100,000 from mom, and started my own .com. And boy, was that a journey. I mean, I was out of money in 6 months, and pivoted, and then we ended up getting about $44 million in venture capital over the next couple of years, and became the fastest growing business in the Midwest region of the United States in the late 90s. Our revenues were doubling every 3 months, and it was insane. I mean, so the pivot was the right pivot. And, but it, so blew it up to 300 employees and hundreds of millions of revs, and then lost everything in the tech wreck. So it was a whole journey, and I during that process, I went from kind of I was just a good engineer. I was just a nerd. Didn't know anything about money. Didn't know anything about business. I was a terrible businessman, terrible marketer. I could kind of sell just because I was just had the raw materials to sell, but I learned all those skills during this process, primarily through the people I hired, and then pivoted into finance here when I started Aspen.
It might be a bit of an aside, but I got a quick question. So the crash, I'm younger, I'm 28, so I was 3 during the .com blow up. When that happened, was it the fundamental business that failed, or was it just the debt and the money side of the business that had brought the capital that was no longer willing to keep you liquid?
It was a combo of both. So what happens when you take venture capital, they put you on a high growth trajectory. So they take you to the trough and they fatten you up. And so we were fattened up, and that trough, right, is capital. And so they get you in a high CapEx program, a high hiring program. So before I took VC, the business was sustainable. After I took VC, the business was no longer sustainable, meaning we required cash infusions only because we're on this massive growth trajectory. It's very expensive to grow, very expensive, because you hire people, you spend money, you do R&D all in advance of revs, right? And so we were fine until we got VC, so it's kind of both. They put you in this program, and then all of a sudden, we went out the last round of capital. We went out to raise our C round, and we wanted to raise $25 million just to prepare ourselves for an IPO. It blew up to 45. All of our investors were demanding room to put in 45 million. We negotiated it down to 35. And then a year later, the IPO window had closed. We went to raise, hey, let's do another 5 just to extend the window. Couldn't raise a dime. Wow. So investor appetite. This is every sphincter in every American was tighter than the drum. Yeah. And so this is one of the lessons I learned was that when the times are good, everybody's throwing money at you, and when times are bad, it doesn't matter what you do, you can't raise a dime. And which really led me into, more asset-based investing in real estate, kind of things, where I wanted things that were more predictable. I wanted things that were not dependent upon sentiment of some market sentiment. Right. And, so that led me into Aspen.
And it was around 2012, right, that you and Jim started doing second position leans and
right.
have really built this. And you built this around wanting to be more on the debt side and wanting to have invest in things that are on the big macro picture. Do you want to talk a little bit, because I believe really your core investment focus is around macro trends. Do you want to talk about kind of that transition in your mind? Was there something that clicked, or was it all the finance people you hired that taught you stuff?
Yeah, no, it was so, having lost everything, it does tend to, I'm thick, but I can learn things. And so when you lose everything, it tends to be a learning moment. And then I did it again. So it once wasn't enough. So then I went and I became a professional stock market investor, professional trader, was very good. and was making a ton of money. And then went public and officially shut that down. Sorry. So I started became a professional stock market investor and then went public literally September of 2008 and lost everything again in the public markets. And after that, I'm like, I'm freaking done. I wanted nothing to do with the public markets. I want, what sounds good to me as an investor is like, give me an apartment complex, where people pay rent, they pay me rent, and so I made a whole pivot. And at the time, it wasn't apartments. So, I'm just simplifying, but at the time there was, we could buy distressed debt. We could buy defaulted mortgages for pennies on the dollar and out of the great financial crisis. And my partner, Jim, had figured out how to do that. And so we bought a bunch of these things and made gobs and gobs of money. And so that started. So what happened is out of that, I became passionate about understanding the winds, right? The winds of the earth. Where are the winds blowing? Where are the tides coming in? I want to know what's happening. And I want to invest with the trends. And I remember sitting in my, it was a defining moment sitting on my desk in 2009 when Miami beachfront condos, or it was about 2012, I think, Miami beachfront condos were selling for $35,000 a pop and had no takers. When I realized this was a buying moment, right? This was an epic generational buying moment when capital is, when wealth is made. Mm-hmm. And at the time I didn't have any access to capital. And I thought, okay, I want to get smart. I want to identify trends. I want to start to collect investors who want to be macro driven investors who can respond when these things happen. And so we've got a few of these, like right now, trends that we're playing, very, very big trends that we're playing right now.
And I haven't discussed this in depth with Dustin, but me and him tend to be aligned. He's probably a little more in this camp than me, but he thinks macro is just kind of a waste of time. But I don't. But I'm going to caveat that it's the guys who get really in depth in like the micro of the macro, right? Like even Dustin, you want to explain a little more? Because I think we both agree that Bob has a lot of very valuable views.
Bob's style of macro, to clarify my position on this, Bob, your style of macro is very valuable. It's the people that make a living off of the monetary system and all sorts of crazy things, and basically it's perpetual doomerism, right? Like that's and they position themselves as macro experts. That's the type of macro.
Yeah, Dustin, I'm actually 100% agreeing with you on that. Anybody who is talking doom, the hard money guys and the anti-Fed guys, the gold standard guys, honestly, they're just a bunch of idiots, all of them, a whole collection of them. And there's not a true economist in the midst of them. So, and the truth is, America and the economy of the world adapts, right? The economy is not a fixed thing. It is Dustin sitting there in his office. And if what Dustin is doing quits working, guess what? Dustin's smart enough. He's going to pivot to something else. And the GDP is going to grow. Why? Because Dustin is going to figure something out. And if nothing's working, he's going to figure something out. And so is Adam, and so is everybody else. So to bet against the economy, you're betting against human activity and human innovation and human adaptability, which it's really not wise to do that. And yeah, there's issues. We have plenty of issues. There's no question. But most of them we're going to work through.
I'm going to clip what you just said right there, and I'm going to set it to auto post to social media every single day. Because that's my whole thesis, right? Is like, yes, you can you can have these theories and everything in the past and the setup is true, and you're extrapolating out to the future. And the assumption is that humans and like people who are naturally innovative and want to solve problems are not going to want to try to solve those problems.
Right.
And it's just so counterintuitive. But it's very easy to project that out, and everyone hears it. They think it sounds very smart.
Well, they're all selling a doom package is what they're doing. They're selling fear. And don't buy it. Anybody who buys fear is buying a ticket on the poverty train. Don't do it. Yep. Warren Buffett, the most successful investor of all says, don't bet against America. Don't ever do it. It's never going to work out for you. So
totally agree. Thanks for teeing us up on that one, Adam. That was
I'm glad I gave you guys a talking point there. Is there anything you want to ask Dustin before I dive into a few other things?
No, I mean, I could, I shoot, this conversation could go on for 2 hours. I had to laugh going back. Bob, you mentioned that you guys were raising a Series C and that you're aiming for 25 million. And that feels so quaint nowadays when you got Series A,
Yeah, this was
$50 million Series A, right? Like,
this was 40 years ago.
yeah,
So.
yeah. It's just funny hearing that, but
Not
no,
40
Adam,
years ago. Sorry, this was 25 years ago. Yeah.
Adam, go ahead. I don't have anything specific right now that
So-
won't completely derail the conversation here.
One thing that I'd love to pivot to is you're releasing a book right now, right? It's available for pre-order. Tell us a little more about
super
that.
excited about this. So, Adam, thank you for asking. I'm passionate about this. Okay. I've watched people putting their money into the stock market and with a hope and a prayer and a financial system that you guys know that is just, it's gamed. It's not, doesn't help individuals like it should. And you get this incredible amount of volatility and can't earn income, can't get good tax benefits, et cetera. And the truth is, none of the billionaires invest that way. None of them buy the stock market. So your advisors tell you, just buy the stock market, buy an index fund and forget about it. And don't worry about the volatility. Not a single institutional investor does this. Not a single ultra wealthy, not a single endowment. None of the big boys, no billionaires do this. And they make much higher returns and they take far less risk than the normal person. And so I am passionate to kind of crack the code on this. It's called Invest Like a Billionaire. And John Maxwell wrote the foreword for and is publishing the book with us. I'm super excited about that. Already it's been called phenomenal and a seminal book. And really, it's uncracking the code for the little guy. How do you do this? And it is primarily through private alternatives, which are far less volatile than the stock market and have superpowers. I go through all of the different 7 asset classes and go through each of their superpowers, how to use them, right, to the maximum benefit, how billionaires use them. Then I go how to structure them, how to do due diligence on them, this kind of thing. So the book is really kind of a real how-to guide to unlock investing like the big boys do with higher returns and lower volatility.
One of the things that you talk about frequently is uncorrelated assets. Do you want to dive into that a little bit?
Absolutely. And have you ever noticed, you guys are in the stock market? So some of your listeners, right, they're probably all these tech guys love to play the stock market, right? So you probably got a lot of stock market investors. You ever notice that on a red day, everything is red, right? Have you ever noticed that? Well, Explain that to me. Why, if Google missed their numbers, does apartment complexes tank? Okay. It makes no sense whatsoever. And that's what's happening is the markets, the public markets are all correlated. I have a couple of charts in the book. I show you how everything is correlated to everything. And since the great financial crisis, it's gotten way worse. Everything is correlated to everything. And the reason is because people are trading the market based on indexes and futures. And when you buy one, ES mini, well, you're buying 500 stocks. And so they all go up and down together. And that's what happens. And there's a lot of reasons. But the key to there's a guy named Harry Markowitz that in 1952 discovered this thing called modern portfolio theory, and he won the Nobel Prize for it in 1990. And it's this idea that if you get uncorrelated assets, meaning, not diversified, there's a big difference, right? You can have diversified assets, but no, it's uncorrelated. It means it zigs when something else zags, right? That's what it means. That if you do that, your portfolio volatility drops enormously by doing that. And so that's the way the billionaires play the game. They get uncorrelated assets. When you buy lithium mine or timber or farmland, right? Think about how correlated it is to the stock market. Not at all. It has nothing to do with the stock market. And you buy a bunch of these things and guess what? The stock market has a bad day. You just don't care. And not only that, but they have higher returns. So they have excellent returns. So you put together a real portfolio of these things. You have what I call the billionaire portfolio allocation model in the book, and kind of lines out how to actually do this to get the most benefit of lack of correlation.
One thing that I'm curious of, and it's tying kind of these uncorrelated assets together, because I think people do what they're familiar with, right? So if you've always bought single family homes, you want to go buy single family homes. And I think this happens a lot when we talk to limited partners and we're looking at maybe making that first investment into a private placement. They're like, well, all I've ever done is bought stocks, right? And I can sell it tomorrow when I decide I've made a bad decision. And I'm going to add one more caveat to that. What if they've made a bad investment and in a private placement it didn't go well? Like, you've gone from being a tech entrepreneur to being a stock trader to now owning this firm, and you've learned something along the way, right? You didn't let the last loss stop you from moving forward. So how do you look at kind of building that portfolio, or even just mentally taking that step forward?
Well, and there's this theory called resilience theory, right? That the successful people are the ones who are resilient, right? And I think of having a loss in a private placement is the best thing that could happen to you, to be honest. Okay. Because then maybe you'll stop just throwing money at things, right? And start taking the time to do due diligence. Here's what I tell investors. I say, when approaching private placements, you should have a no looking for a yes. Start with a no looking for a yes, right? Generally people don't do enough due diligence. They just follow the crowd. They follow whatever, someone else is doing. They get referrals from non-sophisticated, non-successful private alts investors. You need to get, the only referrals you should ever accept are from successful private alts investors, period. And so you get in these really janky investments. And, so the best thing that can happen to you is you get out of that mode where you get a little cautious and you start doing some due diligence and start asking questions, start networking and upping your game, level up your game. Yeah. There's plenty of bad operators. One of my favorite charts in the book is from JP Morgan. And it shows, so in the public markets, real estate. So real estate managers, the very best managers make like 8 point something percent returns. The very worst managers make like 7.8% returns. There's almost no difference between the best and the worst. Go to the private side. The best guys doubling what the private guys or what public guys are making. The worst guys lose money. They don't make anything. And so this is the way you can up your game, right? Is by manager selection. Manager selection is absolutely paramount in private placements. It's absolutely paramount, but it's also the way you can differentiate yourself, right? As a stock picker in the public markets, good luck. It's impossible to differentiate yourself. You're going to get creamed. I've done it. Okay. But in the private markets, heck yeah, go be a really good private alts investor. Join the masterminds, go to the conferences, listen to the podcasts, right? Network with other experienced private alts investors, up your game, figure out how to do good due diligence, which is not that hard to do. And we outline that in the book as well. And all of a sudden you can be the guy that's doubling what the public markets are doing. Right. So look at it as a challenge, you smarties out there listening. Look at it as a challenge. Like, hey, you figured out how to, new coding platform, or you figured out how to crack AI. Well, figure out how to be a great investor. And, don't sit there and say, oh, it's beyond me. Right. I can't do that. Come on,
yeah.
Better than that. Right.
Yeah. I think most listeners, and I think probably especially tech people, are going to tend to be higher IQ than probably most stockbrokers out there, and have the ability to go figure. Most of it's numbers anyway.
Yeah. It is. You really can figure this out. Really, what is necessary, and I'll poke you in the eye to tell you to do it there. But it's just effort. It's just take a little bit of focus and do this. I have an example in the book, of showing that just making 8.8% returns. Over a 40-year career, a doctor that takes 20% of her savings and invests it and can earn 8% returns will beat her the value of her portfolio will beat the entire value of her career at 8%. And if you can earn 13%, which is what, alts guys can do, you go 4x more than the value of your career. So take the time to go learn to be a great investor, right? And this is where the billionaires are different, right? They do focus. They don't let someone else manage their money. They don't outsource their money, right? They go become great investors. Yeah, get help, get advice. No problem getting advice, but you're the CEO of the money.
I think that's super valuable information and a really interesting perspective on it. I want to dive a little bit more into risk, and I kind of want to tie it to a hobby that we have in common. We're both pilots. And when you go end up and fly a plane, right? Yeah, and you fly it's a Cirrus, right? SR-22.
Yeah,
it's
turbo.
It's turbo. That's what I
right,
like.
At
some
some
point we have Dustin also. Dustin, you finished your soloing, but you haven't.
Come on.
I know. Right? So I soloed. I actually soloed. I soloed before I got my driver's license when I was 16.
Wow,
and
impressive.
So just like couple days apart. But then life and school and being a poor college kid got in the way of finishing that out, and I've just never gotten the private pilot. So one day, and actually the SR-22T is my goal plane. I want to. It will get me over to the coast, over to Hilton Head very easily from where I live here in East Tennessee. So that's.
Get you down to Kansas City for the investor meetups at the winery. It'll get you everywhere you need to be.
Exactly. I just flew to Key West to Naples, Florida with my wife. It was a blast.
Awesome.
That's awesome. But every time we go out and we fly a plane, or at least you're supposed to, sometimes maybe I'm a little lax on it, but you've got a checklist, right? You do a pre-flight checklist, and kind of the same way that you were just talking about when you go in to start underwriting a deal, you're going to come in with a no and look for all the things to make it a yes. And I think it's similar when you're going around a plane, right? You're coming in saying, is there a reason I shouldn't be flying this, right? Do the rudders not move, right? Like what's broken on here that's causing me not being able to fly this? My comms not turn on? All of those things you're starting to look at. So how do you're analytical from a computer science perspective. You have a pilot's license, so you understand risk management. I think there's very, very serious risk management in being a pilot. How does that shape your investing approach?
Well, I think just like you said, I think it absolutely shapes the investing approach. By nature, I'm a risk taker, right? That's my nature. I am no longer a risk taking investor. Okay, I just aren't. I've made enough investments that didn't turn out well, not in Aspen, thankfully, but in my personal portfolio, that I'm very, a little bit, I wouldn't say cynical, but I'm not easy to convince, right? And I see the red flags now. So I think it's noticing the red flags, right? I mean, as a pilot, you look at there's a little bit of painted red in the weather, and there's a little bit of lightning strikes there. I think I can do that. It's like, no, you turn around the other way and hightail it out of there. You do not mess with that. Yeah. So that's really, I just don't mess with things anymore. If I see, backgrounds that I don't like, I'm done. I don't want drama, right? I don't want any drama. I want people to do what they say. I want really great projects. We just did a podcast talking about, some of these private credit funds that are out there, and literally, they're so bad, they're upside down day one. They're not even in the money day one. They're bailout funds, and
they're all designed to go rescue their own deals.
They're to rescue their own deals. I mean, it's the worst deals imaginable. These are bugs looking for windshields, and they're going to find them. And so just don't. And I know people that are raising capital for this thing. We pulled no punches there, because I don't like that. I don't like people raising money under those auspices, right? And it's going to give us all a bad name.
Yep. Dustin, you want to close us out here?
Yeah. So Bob, we always like asking our guests, we're the Wealth Independence podcast. And so always like asking, what does the word independence or freedom, kind of what do those words mean to you, and how do you manifest those in your life every day?
Yeah. Well, gosh, I'm probably Mr. Independence. I've been self-employed since 1995, and I've never looked back. I'm pretty much unemployable. Maybe that's what independence means, is, no one will ever hire you for a real job because you're you're such a independent dude. And so yeah, I've always been the guy that I just want to be the guy that's making the decisions.
Mm.
You know, I told my partner Jim when I partnered with him, I said, hey, I'm okay doing a 50-50 deal, but I got to be the boss. I'm just most comfortable when I'm when I'm in charge. And he laughed at me. So he didn't work out that way. But so for me, it's just being the boss and being able to pivot, being able to make decisions, being able to do the things I want to do the way I want to do them. And to me, it's the key to success because you build a business around your strengths, right? And so.
No, that's good. That we interviewed Ellis Hammond a few weeks back, and that was he gave a similar answer about being able to build a business and like the independence that provides, and having the skill set and all that. Even if it does make you unemployable, it's still the upside there is a whole lot greater. So, no, that's great. Adam, you got anything else?
I think that's all I've got. Unless there's anything else you want to add, Bob, we're obviously going to have notes to your new book in the release notes right below here on the episode. And is there another way you want people to get in touch with you?
Yeah, go to thebillionairebook.org and pre-order. So if anybody pre-orders this book, we have a bunch of bonuses and giveaways, including my 2025 best investments for 2025 and a webinar. 7 things your financial advisor won't tell you. And and it's really good. And the Ballers framework, which is the 7 rules of billionaire investing. So we have a free webinar and all there. So we're just love you to go pre-order the book.
Well, Bob, we appreciate the time. Thanks so much. This conversation could have gone on for hours and hours, but we definitely appreciate you making the time for us today.
Yeah, fun to be with you guys.
All right. Thanks, Bob. All right. Well, that was great. I was expecting absolutely nothing less from Bob, and we could have kept talking for 2 or 3 hours. He joked about having us back or coming back again or doing it again. So I think he could be a recurring guest because there's a lot of things we could talk about with him.
Yeah, I think it would be really interesting to do a deeper dive on some of the topics because he does do long presentations. He presents all the time about certain macro trends. I think I mentioned it during the interview, but I was up in Breckenridge with him for 5 days. We went skiing, hung out at his house, and it was great. But the whole time it was just investment conversations or what's going on, and he's got a wealth of knowledge, and so it's always really interesting to hear from him. What did you kind of take away from it, Dustin?
I mean, so much. I mean, I think he just probably the big one is just reinforcing kind of his and what he's turned into now Aspen's focus. Aspen does a lot of stuff, right? They don't position themselves as, hey, we're the multifamily people. And I think that reflects Bob's view of Bob's very opportunistic, right? And that's like what he looks for. He talks about looking for trends and trying to see what's going on. And what I view as the right kind of macro is really the whole analogy of skating to where the puck is going. And I think he's very good at that. They've got a good track record. They do multifamily, but oil and gas and seeing the opportunities in private credit. They've done some industrial. So, I like hearing him dive into that. I'm excited too about just hearing him talk about the book and go into that a little bit more. I'm excited to pre-order, excited to read it. It's going to be a little while until September, so I'll be excited to dive into that more. But I think just that whole mindset and sort of he made a I don't know if this was before we started recording or not, but he talked about something in the book and the crash correlation, right?
No, it was in the recording.
Yeah. So, that's interesting, right? And especially his emphasis on non-correlated assets. And that doesn't just, there's a very specific definition there. And, assets that zig when other assets zag. And I think we've talked a little bit about portfolio construction. I think that really gets into that. And that's very important. He made a point about even billionaires are still the CEO of their portfolio, right? They're not just handing it off and saying, well, my money guy handles all of that stuff. And I think that's incredibly important for everyone to, take the time, especially, our listeners who are very smart and are capable of learning this stuff, take the time to dive in, to learn it, to start managing that and really take control over, your investing, your financial future, really.
I think the big part from what you just said there was just take the time to learn, but take the time to ask questions, right? I mean,
Yeah.
grab a link on our calendar, have a call with us, and we'll happily, Dustin puts out an awesome newsletter every week talking about topics, and we get people that respond to it, diving deeper into the conversation, right? So there is all sorts of ways to learn. It's not a 4-year degree with a curriculum, right? It's a lifelong journey, and there's just lots of different ways to do it. And I think he talked a lot about finding someone, finding not passive investors, finding private investors who were successful, right? Not just the guy who happened to throw a few $100,000 into an apartment building, but like the people who are actually successful at it. And I'd like to put myself loosely in that camp, right? I'm on the early stages of it, but basically able to support myself through my businesses and my real estate holdings and continue to learn every day. I mean, what I've learned over the last 5 years, especially during a little bit of the downturn, we've had a soft recession, I'd say, and definitely a changing in the credit markets a lot, which is what a lot of our business is built off of. I think you just learn so much, and you continue to see different ways to analyze deals. I mean, just on my flight to Memphis the other day, I was like, we've got buildings out there that are probably going to be really good home runs in the long term, but right now they are a headache. You know what's not a headache? The private credit fund with Aspen, where we have operators paying 17% to borrow money, right? And those are, you follow the people that are doing really good and understand it. And Bob understands where there's a good macro trend right now, and that's the gap in the credit market. So beating a dead horse there. But
no, I mean, on that, I mean, we just to illustrate how good they are at kind of picking up on these trends, right? I mean, we had a call with folks on Bob's team earlier today, specifically about the credit fund, and they've got deals just coming out their ears, right? Something like $50 million of pipeline right now that they think they could reasonably have,
and so have 15 signed, 50 in the pipeline, 15 signed already, I believe.
Yes, exactly. So I mean, this opportunity, not that it will last forever. We don't know, but
right now people can't invest in it. Right, we're waitlisted. We've got capital ready to write a check, and it's waitlisted until July 1st. So by the time this airs,
that's exactly no. I mean, but that kind of illustrates the scale of this opportunity. This fund launched last year because they were seeing this emerging, and here there's a lot of demand for it. So definitely, I mean, we'll to Bob's book, we'll have a link in the release notes about that, and definitely pre-order, pick up some of the extras that they've got. I think they're doing a lot to promote that and to provide a lot of value to investors and folks who are either already in this space or just interested in learning more. So we'll have a link to it, but I'm excited to read it myself, and definitely encourage everybody else to pick up a copy too. Adam, you got anything else?
No, I say we get out of here.
All right, man. We'll get on out of here. Everybody, thanks for listening. Hope you enjoyed this. Write in, let us know. We got a contact form on the website, wealthindependencepod.com. But we will check you next time. Just remember, where freedom leads, real wealth follows. Thanks, y'all.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice, and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.